Buying Tata and Reliance together does not protect your capital. Millions of retail investors still believe that spreads their total risk. Yet when domestic sentiment shifts, both stocks drop simultaneously. A single market shock quickly wipes out those paper gains. Why do established domestic giants fail to cushion your fall? Holding 5 different equity shares is sitting on one sinking boat. When Nifty 50 slides below key supports, the entire index sinks together. Different company names offer zero structural protection during liquidity crunches. Your account drops because every rupee sits in the exact same asset class. That fatal mistake leads straight into the wisdom of legendary leaders. Ratan Tata famously advised making tough decisions and proving them right. Because flawed portfolios trap your capital, making right moves becomes impossible. If your base lacks defense, market panic forces severe panic selling. Decisive leadership requires building safety buffers before the crisis hits. For massive macroeconomic waves are preparing to test that exact framework. In 2026, global economic crosscurrents are rewriting portfolio rulebooks. Unchecked commodity swings and shifting currencies now squeeze domestic returns. Relying on past bull runs ignores structural headwinds developing right now. Smart capital tracks systemic shifts rather than chasing yesterday's winners. The first major disruption begins directly in international energy corridors. Middle East crude disruptions trigger persistent waves of sticky inflation. Rising fuel expenses instantly inflate everyday transport and logistics costs. Consumer staples manufacturers quickly absorb margin hits or raise shelf prices. Household disposable income shrinks, reducing discretionary stock market inflows. Meanwhile, currency pressure mounts steadily at the foreign exchange window. With the dollar crossing 88 Indian rupees, currency dynamics have transformed permanently. Foreign institutional selling previously triggered severe panic across domestic desks. Today, domestic investors accumulate overseas technology funds to capture dollar strength. Holding foreign currency hedges protects domestic wealth against steady local depreciation. However, international friction also brings unexpected hurdles for local production. Global supply chain realignments present both massive scale and serious risks. While Make in India drives production volumes, component costs stay elevated. Import tariffs on specialized parts squeeze operational margins across electronics manufacturers. Top-line revenue growth hides shrinking operational profitability for heavy industrial firms. Even tech giants face rigorous valuation adjustments in this environment. Massive enterprise AI spending is facing severe pressure from interest rates. Firms pouring trillions into computing infrastructure now demand measurable quarterly payoffs. Prolonged borrowing costs force IT service leaders to trim speculative ventures. A slowdown in enterprise contracts will instantly punish overvalued software multiples. Navigating these stormy conditions requires collective wisdom from active market participants. Every seasoned investor develops proprietary tactics through brutal market cycles. Share your own personal portfolio risk strategies in the comments below. Engaging with practical community experiences sharpens everyone's tactical market perspective. Solid financial insights provide the ultimate defense against erratic market volatility. Let us dismantle the core structural delusion haunting modern retail portfolios. Splitting capital across banking, auto, and IT is still single asset exposure. Every single holding remains tied to identical equity market beta risk. When foreign liquidity withdraws, sector rotation offers zero downside safety net. True allocation demands dividing capital across fundamentally disconnected performance drivers. India's favorite sport provides the perfect tactical blueprint for balance. A world-class cricket squad never fields 11 pure opening batsmen. Because pitches deteriorate under pressure, specialized bowlers must defend the total. Without reliable wicketkeepers and defensive anchors, aggressive scoring collapses completely. Portfolios need specialized roles that function seamlessly through every market phase. First, let us examine the aggressive run scorers driving your capital. Equities serve as the fearless top-order batsmen of your portfolio. Domestic index funds and global tech ETFs generate maximum compounding velocity. During economic expansions, these growth engines outpace broad monetary inflation easily. Yet when market momentum collapses, attacking players cannot defend your capital. That is when disciplined defensive bowlers must step up immediately. High-quality corporate bonds and government debt act as defensive bowlers. Fixed-income securities yield reliable coupon returns regardless of turbulent stock swings. They dramatically dampen portfolio drawdowns when volatile growth sectors correct violently. Liquid sovereign bonds ensure immediate dry powder to exploit discounted valuations. Next comes the watchful wicketkeeper protecting your international purchasing power. Foreign-denominated assets serve as your vigilant, irreplaceable wicketkeeper. Holding US dollar ETFs insulates your wealth from domestic currency erosion. Global funds unlock participation in innovation cycles outside the local ecosystem. This foreign cash reserve guarantees liquidity whenever domestic financial markets seize. Then stands the legendary crisis all-rounder ready for severe storms. Physical gold and sovereign gold bonds represent the ultimate match-winning all-rounder. Gold is far more than traditional wedding jewelry in Indian households. During systemic geopolitical shocks, bullion consistently outperforms distressed paper assets. It holds zero counterparty default risk across deep multi-year global recessions. India's greatest industrialists have used this exact balance for generations. Mukesh Ambani methodically insulates conglomerate balance sheets using tangible hard assets. Reliance balances high-risk telecom and digital bets with massive infrastructure cash flows. Industrial titans never wager their enterprise survival on single market cycles. They structure diverse revenue pillars before expanding aggressive growth initiatives outward. 3 tailored structural blueprints translate this exact principle for you. Young professionals need an aggressive growth framework built for long horizons. Allocate 60% into domestic equities and broad market index funds. Channel 20% into international technology ETFs to harness dollar gains. Anchor the final 20% across sovereign gold and short-term debt. For moderate risk profiles, a different balance provides superior stability. Mid-career wealth builders require smoother compounding curves through changing cycles. Maintain 40% in large-cap equities and disciplined index funds. Commit 30% toward corporate debt and short-duration government bonds. Split the remaining 30% equally between physical gold and dollars. Capital preservation demands an even tighter defensive shield against downturns. Retirees must construct an impenetrable fortress focused entirely on capital safety. Dedicate 50% into government securities and sovereign fixed-income instruments. Place 20% into gold bullion and 20% into large caps. Keep 10% in liquid cash for immediate short-term liquidity needs. Disciplined asset balance preserves generational security through every economic regime. Access the complete portfolio blueprints using the link pinned below. Review your holdings today and rebalance before market volatility accelerates. Financial markets reward systematic discipline far more than speculative timing. In the end, time remains the financial market's greatest teacher. Will your portfolio withstand the next decade of macro shifts?